think the easiest way, if you haven't looked at the industry before, the easiest way to understand this is to say that on the one hand, you have the large diversified groups, um, which are Diageo and Pernod. And so they have global exposure. They work across categories and across price points and across distribution channels. And so you're getting a very broad exposure to alcoholic beverages. And on the other hand, you have Remy Cointreau, which is a very focused business, both in terms of categories, where the vast majority of their earnings are driven by cognac, and also in terms of geographies. They're very much a China and US business. And of course, also in terms of price points, because it's the average selling price, if you look at their portfolio, is much higher than for most of the other companies in this group. David Campari is a bit of a hybrid of the two because they have meaningful exposure to one category, which is aperitifs, and which is quite unique for David Campari, and to one geography, which is Europe. So in that sense, they're quite focused, but they also have a long tail of other brands and categories in bourbon and tequila, etc. So I think that sets the scene nicely, that you have this sort of continuum where on the one hand, Diageo and Pernod are your the place to go if you're looking for sort of broad exposure to the industry. But if you have strong views on a category or geography, then you may want to look at Remy and Campari as well. And of course, there's other companies to consider, such as Brown-Forman in the US, and there's a number of Japanese and Asian listed players. But for this presentation, I will focus on the four. And so historically, top line growth, and this is leading up the decade between the great financial crisis and the pandemic. The two large diversified groups, Diageo and Pernod, typically generated organic growth in the low to mid single digits, and Campari and Remy were in the mid to high single digits. And interestingly, given the current sort of conversation around declines in per capita consumption, that growth was not driven by volumes. If you look at the US market over that time period, overall consumption was pretty flat. So the growth these businesses saw was driven by premiumization, and in terms of earnings growth, there was also mix impact. There was a bit of operating leverage for some of these companies, and there was some impact from share buybacks, mainly in the case of Diageo. And so in an overall flat consumption environment, Diageo and Pernod grew their earnings by about 2/3 over that decade, and Campari and Remy at 80 or 90%, which I think is an interesting context given the sort of current debate around this industry. So what has changed then? Why are the share prices, and these companies that used to be seen as such reliable high quality compounders, why are they now down by 60 to 85%? And the main concern is around a structural decline in consumption. And that's largely been driven by one market, which is the US, where per capita consumption has been in decline since it peaked back in 2022. And that has then driven countless headlines around what are said to be sharp declines in drinking, especially among younger consumers. And while I think it's undeniable that per capita consumption in the US, if you look at 23, 24, 25, has been in decline, I think it needs to be nuanced. And there's a number of points that we need to consider. So first of all, as I alluded to on the previous slide, per capita consumption isn't the only lever for these businesses, and it's not necessary for strong share price performance. And I like to think of this as we're not buying, we're not investing in per capita consumption. We're investing in spirits companies or brewers, and they're two slightly different things. That's not to say that per capita consumption doesn't matter, because if this is the beginning of a very sustained and significant decline in consumption, that will, most certainly have an impact on these businesses. But it's not a linear relationship. And so I think the obsession with data points around per capita consumption, I think, is slightly overdone. Secondly, there are cycles in this industry, and we've seen them before. One example is the early 1990s to the late 1990s in the US, where overall alcohol consumption was down by about 25%, and spirits consumption was down by about 40%. And during that time period, some of these companies indeed did very well. And so we've seen the cycles before. Um, and we could spend an awful lot of time debating whether the current decline in per capita consumption in the US is cyclical or structural. But I think in some ways, um, it may be more sort of productive to consider the fact that we have seen these cycles before, and there's no clear evidence at this point that this is any different. And of course, on top of that, we'll get to the other reasons why I think even if this was to be the beginning of a more sustained downturn like the one we saw in the 80s and 90s, there are other ways of winning here for these companies and for the share prices. Declines in consumption are real in the US in the last 3 years or so, but I think they're generally overstated. And in our view, sentiment and valuations already largely reflect these concerns. So let's start by looking at whether consumption is actually in decline, because of course that's certainly the narrative and has been for some time. So this depends on which geography we're looking at, and I should say most of the data I'm referring to is data on actual consumption sales or consumption. That's sales are the best proxy we have for consumption in this case, as opposed to survey data. And most of this data is also until 2024, because we don't have good full year numbers for 25 yet. We have a pretty good idea that we'll see another year of slight declines in per capita consumption in the US. But based on the actual sales data we have, if we look at the US market, because that's where the current concerns are sort of centered, until the pandemic, per capita consumption was remarkably stable in the US for many decades at around 8 to 10 liters of pure alcohol, LPA. And as I mentioned, we've seen cycles in this, but the long-term average and the long-term range has been remarkably stable over very long time periods. The slight break in that is that since 22, we've seen a 10 to 15% decline in per capita consumption. But I think we need to put that in context. So that, of course, follows on 2 years of very, very strong growth in 20 and 21. And that was largely driven by price. We didn't see that much growth in volumes. Of course, the off-trade saw a lot of volume growth, and the on-trade saw very significant declines. But the value was up by almost 30% over those 2 years. So clearly, the industry took an awful lot of pricing. Now, it's not unique for the alcoholic beverages companies, but I think some of the companies in this group, and especially in some categories like tequila, there was very high rates of inflation, and naturally, that one would expect that to have an impact on affordability and willingness of consumers to continue buying these products coming out of the pandemic. So I think for that reason alone, it's too early to say how much of this is structural and how much is cyclical. And as I mentioned, in any case, we've seen these cycles before. Between the early 80s and late 90s, there was this 25% decline, but then we saw a 15% increase from around 2000 until the pandemic. And most of that came between 2000 and the financial crisis. So how exposed are these companies to the US? Well, it varies. Pernod, less so. They have about a quarter of earnings from there, we estimate, and Diageo is about half of earnings. Interestingly, the US market is only about 17% of the value of the total alcoholic beverages market. which is actually similar to China, but it meaningfully smaller than Europe. But in terms of the profit pool, the US is clearly the most important driver for these companies for a number of reasons. This market, the sort of distribution structure is one of them, the three-tier distribution system. And so it's a very profitable market, and it's a market where we've seen recent declines. And that's why most of the attention is on what's happening in the US market. So that's the US. In Western Europe, there's less to say. We've seen per capita consumption declining for decades. In fact, if you look across most large Western European markets like France, Italy, Spain, and the UK. And for most of these companies, their European exposure is more limited. The exception is Campari, which has about half of earnings from Europe. So these are the developed markets. So in the US, until the pandemic, per capita consumption was actually remarkably stable, and then it's declined by 10 to 15%. We're still waiting for final 25 numbers. In Europe, as I said, it's been in decline for decades. So you could argue that even if we are in structural decline, that's not new because these companies have operated in that environment for a long, long time. Now, emerging markets, with one notable exception being China, emerging markets are a very different story because per capita consumption is generally increasing, and in some cases strongly. So I mentioned the example of India. It's a small market. I think it's about 3% of the global market by value, but it's a good example of growing per capita consumption. It's up by about 50% since the financial crisis. The exception of China is mainly driven by economy baijiu. So baijiu is by far the dominant category of in the Chinese spirits market. The international players that I'm referring to have a pretty small share of that market. It's in the sort of low to mid single digits in aggregate. And so the Chinese market's been driven by baijiu, and economy baijiu has seen significant volume declines over the last 10 years, while the premium end is still, in fact, growing in value terms. And so what I've referred to so far is per capita consumption. Now, if we look at value terms, it's a very different picture because globally, although market volumes are flat over the last 10 years, the value of the global market is up 16%, once again, until the end of 24. And it's grown in every single year apart from 2015 and 2020. And even if we look at the US, volumes have been flat since 2010, but value is up 73%. Obviously, that implies there's been a very significant element of premiumization and mix and price in there. But I think it goes to show that overall volumes consumed are not the only driver, even in terms of top line growth. The data I referred to refers to overall alcohol consumption. It's important when we talk about the spirits group to note that there's also been a shift between wine, spirits, and beer. So spirits over that 10-year period is flat in volumes and up 22% in value. Beer is also flat in volumes and up 16% in value, but wine is down 10% in volumes and up very little in value. So clearly spirits have been gaining share, and that's a very long-standing trend in the industry. One of the, I think, main explanations for this is that clearly there's much more spending on alcoholic beverages is accounted for by female consumers today than if you go back 10, 15, 20 years. And there's a very different set of preferences there. So that has driven this increase share of spirits as a percentage, as a proportion of the overall market. And further, within spirits, there's also been very significant shifts. The data here refers to the US market. So I've mentioned a few categories here just to give you a sense of how in a market where overall consumption has been flat, if you're in the right category or you have the right brand and proposition, you can still see very significant growth. Tequila has clearly been, I think, the the best known example of that. So tequila has grown at 13% CAGR since the GFC, half of that volume. Bourbon's grown at 8%, half of that volume. Clearly, at the moment, tequila has slowed down, and bourbon has hit a very difficult patch. So, but I think it still goes to show that over a sustained sort of time period, categories and brands can grow at rates that are very different from the overall market. Cognac grew over that period at 4% flat volumes. If we look at individual brands, there's even more dispersion. I mentioned a few here that are controlled by the four European groups that we're discussing. So if we look at Don Julio, for instance, has grown at more than 50% CAGR. Espolòn, owned by Campari, at 38%, Aperol at 36%, etc. Campari at 16%. And some of these, or many of these, were, of course, meaningful brands to begin with. Some of them come from a small base, but some were meaningful brands even at the beginning of this measurement period. So I think it goes to show that there are so many layers to this. I don't think it's. I think we'll then end up drawing the wrong conclusions if we say that per capita consumption is flat or down, and that means that all these companies and brands are doomed. Even if overall consumption, in fact, continues down, there are clearly other ways of creating value. And if you find the right brands and categories, you can even grow your business. Briefly on market share dynamics, I think it's interesting to note this is a global picture, but it's still a very highly fragmented industry. Diageo, which is the largest international spirits player, has less than 5% of the global market. Pernod is at 3%, and Campari at 1%. Of course, this varies significantly by market. In some markets, there's much more concentration, right? So in many Western European markets, for instance, there's much more concentration in the hands of a handful of companies. But it does show that it's a very different environment from the beer business, which has been consolidated to a much higher degree, of course. And interestingly, private label and independent brands, which I think if we go back 10 years, certainly, there was an expectation that private label, but especially independent or craft brands, would take much of this market. They have actually been flat over the last decade as a proportion of the overall market. And within spirits, they've declined in aggregate. So I think that shows the true sort of durability and strength of these brands. I wanted to say a few words about survey data because most of the headlines around this industry, I think in the last year or two, have been, or many of the headlines at least, have been driven by survey data. And it's always been misleading. I've seen a number of estimates that suggest that in mature markets like the US, self-reported consumption probably averages at around half of actual sales of alcohol. And so you could argue that that's always been an issue. But I think what is interesting is it's become increasingly misleading. And I mentioned a few examples here. The Gallup poll, I've chosen that one because it's probably it's one of the most often referred to surveys in this area. And so if you look at the Gallup poll from last year, that suggests that self-reported consumption in the US was down 1/3 in 2025 compared to 20 years earlier. So the average American says they drink 1/3 less than 20 years earlier. But if you look at actual sales of alcohol in units of liters of pure alcohol per capita, it's slightly up in that period. So there's a huge discrepancy, right? Consumers are saying they drink 1/3 less, and in fact, they drink a little bit more. The other one I thought was interesting from the Gallup poll is that I think there's a general concern among investors that currently that all these very negative headlines around the industry and some of the advice we're seeing from the WHO, etc., that there's no safe level of drinking. There's a real concern that this will have a real impact on consumer behavior. Interestingly, consumers haven't ignored this advice, right? So if you look at the Gallup poll again, in 2000, in the year 2000, 27% of Americans surveyed thought that moderate drinking was bad for their health. Uh, Last year, that number, so it says 2005, but that should be 2025. Last year, that number was up to 53%. So the proportion of Americans think it's bad to drink moderate amounts of alcohol has gone from about a quarter to more than half. In that time period, actual consumption was actually up somewhat. And so while there's a lot of headlines and noise around this, and I'm not saying it will never have an impact on consumer behavior, but what we can see from the last 20 or 25 years is that even if consumers agree with the idea that moderate and there's I say even if they agree with the idea because there's a lot of disagreement around this actually, but even if they agree with the idea that moderate consumption is bad for you, they carry on drinking, and in fact consumption is up slightly, and I think that's very interesting. um, I also noticed that the industry is beginning to emphasize the social aspects and benefits of drinking. I always thought it's somewhat odd that the industry tries so hard to promote the sort of the health benefits of moderate consumption, because I suspect most consumers consume these products not because they think it's good for them, but because they enjoy it, and there are other benefits. And one recent example of this is Heineken CEO, who's now announced that he will be retiring, but he came out last year and promoted this idea of the social benefits of drinking, and I think in some ways it might be wise for others in the industry to embrace that. I think there's been there's especially been alarm around younger consumers drinking less, and it's very difficult to measure this because once again, it's survey data, and to my mind, there's no good data on actual spending by age cohort. But what it does seem to suggest, this is the Michigan survey, is that the decline in younger consumers seems to mainly have been driven by underage consumers, which is, of course, a good thing, and also in the very youngest cohorts, so up to 22 years of age. And that's been the case for a long, long time. So even if these consumers would have graduated into older age cohorts, it seems that once they do, we now have a pretty good sense that their behavior seems to revert to the historical patterns. Now, of course, that can change, but I think the idea that the narrative is that it already has changed, which doesn't seem to actually fit the data. I mean, I personally also think that the sense that many have that younger people don't drink anymore is also driven by the fact that the people who promote the sort of health benefits of not drinking, etc., are also probably some of the most vocal in terms of their social media presence. So I think you get a slightly skewed representation if you only look at that. So let's move on to the question. So that's a lot of sort of data and background on actual volumes consumed and how they've sort of trended over time. So then let's ask the next question, which is, does it actually matter whether consumption is in decline or not? And I would argue it's not a clear relationship between per capita consumption and volumes. Between per capita consumption and earnings and share prices, of course. So I think I mentioned this example of between the GFC and the pandemic, the US market was flattish in terms of per capita consumption, but these groups grew their earnings by 65 to 90%, driven by premiumization, market share gains, especially for Campari, operating leverage, buybacks in the case of Diageo, etc. And there's examples of this going back even further in the 80s and 90s. I also think, interestingly, if you look at other sectors, this is a whole long discussion in itself about the sort of similarities and differences with tobacco and carbonated soft drinks. But I think it's clear that there are ways of creating value even in an environment and in an industry where you haven't got any growth in volumes. And I think the examples I mentioned here are quite interesting to look at. I would also say that when you look at overall consumption levels, we need to remember that for many or some of these groups, they're mainly they mainly operate in the premium or super premium or prestige segment of the market, and premiumization is still happening there. I mentioned a few examples: US and China premium beer, US premium vodka, etc. And in many of those premium segments and up, you not only do you see value growth in 23 and 24, but you also see volume growth. So I think there's a lot more nuance to this than headlines would suggest. There's also other ways of creating value for these companies. One of them would be on the sort of efficiency side of things. In fact, if you look at the last 10 or 15 years, there's been hardly any operating leverage in these businesses, and they've maintained very relatively high investment levels. And in some cases, they've increased investment levels as a proportion of sales. Campari is an example of that, through building out their direct distribution network, etc. And I think if growth remains low, there's an opportunity at least to take out costs. Whether the mindset in the industry and in these boardrooms will sort of change to embrace that, we'll have to see. But there's clearly an opportunity. The other one would be share buybacks. Clearly, at the valuations these shares are trading now, that's a much more interesting proposition than 10 years ago. The issue is, as I see, twofold. One is these groups are generally quite levered. And so I think, in the short to medium term, I think they'll struggle to buy back meaningful amounts of stock. And the other one is that many of these groups, Diageo is one exception, but many of them are family controlled. And so there are issues around liquidity and ownership limits, etc. But if we look at Diageo as an example, they bought back about 25-30% over the last 2 decades, which is very meaningful. What about share prices and sentiment then? Very briefly on this. Clearly, valuations have come down a long way. If I look at the free cash flow yield of the large diversified groups, they're higher. They're at 6 to 8%, depending on, well, clearly which year we're looking at, but also in terms of how you normalize capex and other things. Campari's at around 5%, and Remy's at around 3%, and that seems like a big range. But that has always been the case, that the focused groups, Remy and Campari, trade at higher valuations, lower free cash flow yields, and the diversified groups tend to trade at lower valuations and higher free cash flow yields. And over time, the focus groups have generated higher earnings growth, but they've also shown much more volatility. And so it becomes almost a philosophical question. Are you sort of comfortable with that volatility, or do you want one exposure that is much more diversified? I think in terms of valuations, we also need to consider that earnings have come down. In the case of Campari, not very much. They're down about 10% from the peak, but in the case of Remy, it's by about 70%. And so, of course, when we look at valuations 1 or 2 years out, in the case of Remy at least, we're looking at earnings levels that are much lower than pre-pandemic or even mid-pandemic. And within the industry, as I said, there are a couple of things to consider.